All right, everyone, we are live. Welcome, 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 welcome to the show. There's people that I got to invite. I promised that I would invite to this today. We are on part three, right, of becoming your own bank. We were doing a historical treatise. We're on the third day of the third part of that, which might end up being a part four, but I doubt it because this might be a short one. But I might just end up doing the whole thing. There's some pieces that I wanted to have in PowerPoint for you all that I was not able to get ready yet, but I will have it. So I might do a part four. If I do, it'll be late tonight, early tomorrow morning sometime on that. Hold 1 second as I make sure that I am able to get people on. Share this with everybody that you know. Get people on, right? We want to get this information to as many people as possible, right? And we're going to work together in order to get to where it is we want to get to, okay? So let me get on this live on my phone and so I can share this with other people at the same time. So hold 1 second for me. Let's do this. Let me go here. We go here. Home. Come on to my page, please. Thank you. There we go. And let me share this now. And again, just hit the share button. You can share this with people. Let's share now. So again, we are in the middle of part three here, the workshop three, becoming your own bank. We already did the one, understanding money, right? Part one. And then part two was legally avoid taxes. This one is specifically on becoming your own bank, right? And I'm going to go ahead and share this to people I know that are looking to come, right? So let me see who I can get on for the day, right? Just going down the line. Letting people in, come on, climb in, get in. Those that want to, and share this on your page, share it with everybody you know. Get them in, get it started. Right. Welcome to my people that's on YouTube. Welcome to my people on Facebook. Welcome to my people on LinkedIn. Welcome to my people on Twitter. Welcome to my people on um, what else? Twitch. All of you all. You guys have been staunch supporters. I appreciate it. Let's keep moving, keep moving, keep moving. We're growing together, working together, making it happen. And so I'm going to give people a couple more seconds to get on. While they do that, I'm going to be talking about a little bit about what we have going on tonight. So today, some of you already saw where we went over this morning, right? We did the Rich Dad, Poor Dad, part 7. We're now doing the Become Your Own Bank, right? This is actually workshop 3, part 3 of workshop 3. This is the longest workshop. Probably we won't have another workshop with parts to it, but this one, it was important for us to get the historical treatise on it. And then we're going to do the which this will be the last part of that. And then we're going to go into possibly a part 4 of this, but into definitely the next workshop will be increase your cash flow, right? So we want to increase our cash flow, keep that moving as well. How you can do that, ways that you're going to be able to do that as well. Okay. If you missed any of our previous workshops, you can get to them on our YouTube station. They're in order. If you hit the live, if you go to Let's Talk Credit, if you go to that portion and check that, as well as they are on our Facebook page, LinkedIn page, all of those. You should be able to click videos, or on Facebook you can click my picture and you can pull them up. They'll come up pretty much in order for you, okay? And just go through the different ones. Now tonight at 7:00 p.m. we have our Sunday sneak peek where you can come in. We will work with you. It's like a workshop where we work with you, walk you through the process. You can see how we work with people and what we do in order to help individuals walk through our process and get with the experts. And the last thing is that you can do is that you will also be able to have a mindset training at the beginning of that, which is really good. Just like we do the Rich Dad, Poor Dad on here, except it's going to be a much more, it'll be a succinct version of that as well. Before we get into walking people through the process, we have breakout rooms where we go through each and every different one of our services, and wherever you need help, we will help you. And so we've opened it up for everyone, public as well as those that are already working with us, to be able to come in and you can get a sneak peek of how we work, what we do, and how it works. And so that's extremely powerful. And then I've also been invited to the Lions Den. As many of you might already know, the Lions Den, they have invited me to do tonight, late night, 9:30 p.m. Central Standard Time, 10:30 p.m. Eastern Standard Time, and 7:30 p.m. Pacific Standard Time, to be able to do it. Claire, welcome. I'm glad to see that you are in. That is outstanding. I'm glad that you were able to get on as well as our people that's on the other channels. Great to see you all here. And again, like I said, so I've been invited to this Lions Den for tonight. All are welcome. If you check any of my pages, you will definitely be able to, or the Let's Talk Credit pages, you will be able to see where you can join the Lions Den tonight. It'll be on YouTube. It will not be on any of my stations, really. It's going to be on YouTube. And so I advise you to take hold of that now. If you have questions on how to get there, please put it in the chat. I will definitely get you a link to do that. Okay. So if you put it in the chat, I'll know that you need a copy of the link to get there, and I will definitely get you to that tonight. They're going to be interviewing me. It's going to go really well. And I'm super excited. I love doing interviews. So I'm super excited about that interview. All right. So again, we're going to be in the workshop 3, Become Your Own Bank, Financial Literacy. We're getting that going. Okay. Make sure you subscribe to our channels. Make sure you like our channels. All right. As well. And then also make sure that you, subscribe, you like, and that you chat with us, okay? Or put something in the chat or inbox me directly if you want more information. Also, you can text savings to 833-740-2315 for more information. Again, you can text savings to 833-740, 2315. All right. So welcome. So we're going to go ahead and get started pretty much where we left off last night. Which is going to be the Federal Reserve cuts interest rates, right? So we've just been going straight down the timeline of understanding and walking through the banking and then the crisis. So remember, this actual document here, when you get to when you start getting the 2000s, they call this the U.S. financial crisis. And so really it started in like 1992, but now we're here. And so now we're at where the Federal Reserve cuts interest rates. And as I was saying last night, and I went into detail on the dot-com bubble and what happened, but basically what happened was that they did not understand the implication, the international implications of the economy when the internet was going to bring forward, right? So they didn't understand that. Due to the fact of them not understanding that, they considered it a bubble. They increased the interest rates, right? And so all of those loans that went through and all of the stocks actually that people were they considered them inflated stocks, and it caused the bubble to crash. I mean, the dot-com to crash at that time in 2000. And that's where we left off. So let's read from here, right? So, and then the other thing I want you to recognize is, as we went through this, I want you to see the ebbs and flows and how everything came to being, right? So what did we see as far as the ebbs and flows were concerned? We saw that the inside of this crash and inside of this process and inside of the situations that were taking place, you saw first the banking was what? Unregulated. First, there was no banking system. Then it went to the unregulated, right? And this is when everybody jumped in. It was like the gold rush, right, for banking. And that's for any industry. And so when you hear these words, unregulated, the market share is about 1 to 3%. It's a new market and it's unregulated. You want to jump into those markets. That's a very important time to get in those markets, because this is the time when there's a lot of money that can be made before the government comes in and starts regulating. And I use the internet as an example of that before, right? To let you know, the internet was unregulated. You didn't even have to pay tax. If you sold something on the internet, you did not have to pay tax on it, period, right? And that lasted for about 5 to 10 years. But then they came in with the regulations because they said what? That the other country, they induced panic, which we saw every so many years they would do what? You see this all through that timeline, right? But they did the same thing with the internet. They induced panic. They said that the other countries could come in the back end if we don't regulate this, and they can steal people's information, this and that, da 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 da. So everybody agrees with that. But then once that agreement came into effect, then what do? They taxed the internet. So now it's tax. You got to pay tax when you do sales over the internet. But there was a time when you didn't. So what you could do with all that extra money is the key. And so when an industry is unregulated, right, then what's going to happen is it's a good time to get in. Then when they deregulate it, once it becomes regulated and they deregulate, that's another good time to come in. Right. And it's purposefully done, right, in order to induce that type of behavior. So you have to just be able to read it and understand when you should be in a market, when you should not be in a market, period. Right. So I just want you to get that as we go through the timeline. Now, we're going to go back through and start. I hit the wrong button. Now we're good. All right. And I might have just hit the wrong button, but you guys should see the proper thing. So, prompted by the burst of the dot-com bubble and the resulting recession, the U.S. Federal Reserve, led by Alan Greenspan, lowers its benchmark interest rate 11 times. Falling interest rates lead to an easy credit environment, encouraging lending practices that prove unstable later, right? So this is happening after the dot-com crash, right? Then they cut the interest rates, right? So now falling interest rates lead to an easy credit environment, encouraging lending practices that prove unstable later in the decade. The ensuing credit bubble plays a large role in the run-up to the financial crisis. Now they're talking about 2008 crisis that they're about to run up into, right, due to the real estate crash. Okay, so now we're moving to 2004. In April, the Securities and Exchange Commission loosens the net capital rule, which had limited broker-dealers and investment banks to a 12-to-1 leverage. And I think this is where we left off. We talked about this last night. So this is a 12-to-1 leverage. But remember, if you were on the call last night, you realize they went to an unlimited leverage. And what they're talking about now is where this is talking about options trading, right? So in options trading, they had a 12-to-1 leverage. But then what happened? The change allows firms with more than $5 billion in assets to leverage themselves an unlimited number of times. Qualifying firms at the time include Bear Stearns, Lehman Brothers, Merrill Lynch, Goldman Sachs, and Morgan Stanley. These firms greatly increased the amount of leverage they employ to a point where they routinely use 30 times leverage on investments. So they're able to take the investments that are coming in and leverage those, 30 times. So now you see how a bubble can be produced, right? But they still leverage like this. Banks are able to leverage your money that you put in your account 9 times. Though this is a stock market leveraging, it's the same idea. I want you to be clear. So none of the 5 firms survived the 2008 credit crisis intact as independent investment banks. None of them survived the 2008 credit crisis, right? Now let's keep going. So it wasn't just housing. You had that side as well. So now we're in 2007. A boom in U.S. housing prices abruptly reverses course in 2006. Declines accelerate in 2007, which will see the largest single-year drop in U.S. home sales in more than 2 decades, right? The downturn prompts a collapse of the U.S. subprime mortgage industry, which offered loans to individuals with poor credit. So this were loans to people with poor credit, right? Sometimes without requiring a down payment, right? This was when you heard real strong buy houses with no down payment. Not like today, it's a little different, but because they put regulations in place, but this time this was really like no down payment. More than 25 subprime lending firms declared bankruptcy in February and March of 2007. The collapse rattles the Dow Jones Industry Average, which measures the combined stock values of the 30 largest companies in the United States, which we saw on part 1, I believe, of this. We saw where, no, that was part 2, where the Dow Jones Industrial Average, right, is what is used to measure everything as far as when it comes to stock. On February 27th, it loses, or it becomes the name brand, the household name for it. On February 27th, it loses 416 points, its biggest one-day point loss since 9/11, right? So now, April 2007, subprime bankruptcies proliferate. In April 2007, New Century Financial Corporation, the largest U.S. subprime lender, files for bankruptcy. As analysts worry about the impact subprime mortgages will have on the broader financial sector, which invested heavily in scrutinized debt from subprime loans, in July, Bear Stearns, one of the largest U.S. investment banks, announces two of its hedge funds have lost almost all of their investor capital and will file for bankruptcy. It is one of the first signs of major problems in financial markets beyond the subprime loan industry. Okay. So this right here is important, right? Subprime bankruptcies proliferate. This is super important to get. This was step one, subprime. And it's a movie out. And for some reason, I can't think of the name of the movie, but that movie deals directly with the subprime, right? Mortgages, right? And what happened during that time and how it fell. Now, in 2007, August 2007, subprime woes go global. Subprime mortgage problems spread worldwide as hedge funds and banks around the globe revealed substantial holdings of mortgage-backed securities. France's BNP Paribas announced on August 9th that there is no liquidity in the market for assets held by three of its hedge funds, as investors reject these so-called toxic assets, which are rapidly losing their value. Other European banks follow with similar announcements. The European Central Bank immediately steps in to offer low interest credit lines to support these banks. With lending markets drying up around the world, the central banks of the United States, the European Union, Australia, Canada, and Japan coordinate to inject liquidity into credit markets for the first time since 9/11. Now, September 2007, the Fed slashes rates and market peaks. In September, the Federal Reserve makes its first in a series of interest rate cuts, lowering the benchmark federal funds rate for the first time since 2003, right? So this is a real situation that's taking place here, okay? So now we're starting to see the breakdown, right? We're starting to see the breakdown of the economy at 2007. We're starting to see a real breakdown here. Okay, lowering the benchmark federal funds rate for the first time since 2003 from 5.25% to 4.75%. By 2008, the Fed will cut rates to between 0 and 0.25%. During this period, the Dow Jones Industrial Average peaks at more than 14,000 points. By February 2009, the Dow plummets by more than 50%, just over 6,500. So that was a large crash, right? Or large, crash. That was a crash. 2008. This is when everybody felt it. When you really felt it was 2008. Bear Stearns announces major liquidity problems and is granted a 28-day emergency loan from the New York Federal Reserve Bank. Investors are fearful that the firm's demise could spark a collapse of the financial sector. 2 days later, JP Morgan Chase buys Bear Stearns for $2 per share in a rescue deal backed by $30 billion in Fed financing. Later, it will increase its bid to $10 per share. The bank traded at a high of $172 per share only weeks later, right? So it went from they bought it for, or they were 2 days later, JP Morgan Chase buys Bear Stearns for $2 per share. The bank traded at what? $172 per share only weeks earlier. So from 172 to $2. The sudden collapse and fire sale of one of the most iconic institutions on Wall Street sparked broad fears about the stability of the financial sector. And if you were living at this time, if you were in business at this time, you understand this rippled across all industries. Every industry felt the financial crisis, period. Right? And if you had any business, my trucking company failed around this time, 2 years later, 2010, but we struggled through this time period just due to the fact that what? This industry, right, this was taking place. The banks, credit, as well as housing, right, were going through a major crisis, right? And all building had stopped. And so that was very important. If you are a consumer, you began to see the shelves not being as full as they were. This was the beginning of that. Government nationalizes Fannie and Freddie. The U.S. government announces it will seize control of federal mortgage insurers, Fannie Mae and Freddie Mac, in what is considered Washington's most dramatic intervention in the credit crisis to date. The two firms are riddled with mortgage defaults, and federal regulators fear their collapse could lead to massive collateral damage for financial markets and the U.S. economy. Now, moral hazard and Lehman's collapse. Lehman Brothers, you remember that? Lehman Brothers, a major global investment bank and a fixture on Wall Street for more than 150 years, files for the largest bankruptcy in U.S. history. The announcement spooks many investors who had assumed the U.S. government would act to prevent a bank the size of Lehman from falling, but they fell anyway, right? So the government was supposed to have those acts that we were talking about in part 2. They were supposed to what? Stop any bank from that size from falling or failing, but they didn't. However, U.S. Treasury and Fed leaders fear at the time that bailing out Lehman would create moral hazard within the banking industry, right? Now, Federal Reserve bails out AIG. Just the day after Lehman is allowed to collapse, the Fed steps in to rescue American International Group, AIG. This is the insurance, right? The largest insurer in the United States with an $85 billion loan. Hours earlier, credit agency had downgraded. Nobody believed. And if you were, I don't know if you were watching this or not, but I was glued, right? I was glued to the television at this time watching this take place because I wanted to see the economy and my companies. I needed to make sure that they were going to be good in this economic times. My marketing company was able to survive, but my trucking company did not survive, right? And so what I want you to get is no one believed that they would have let Lehman fall, literally. And this is recent history. This isn't like this happened 100 years ago. This was recent history, 2008, right? So that wasn't that long ago. What was that, like 10, not even 10 years ago, right? Was that 10 years ago? 10, yeah, it was like about, yeah, it was about 15 years ago, right? So credit agency had downgraded AIG, which bet heavily in the credit default swap market, further undermining investor confidence. Policymakers believe that, unlike Lehman, AIG is too big to fall, and to collapse would trigger cascading failures throughout the U.S. and global financial systems. Right? Now, Paulson unveils TARP rescue plan. Treasury Secretary Henry Paulson unveils a rescue plan dubbed the Troubled Asset Relief Program, or TARP, which aims to use $700 billion of U.S. taxpayer money. Remember, that act that they enacted that we talked about yesterday in the 90s allow now, I believe it might have been the 80s, allow now that taxpayer money could be used, right, to be able to bail out the banks, right? Remember that. I told you all legislation, all acts, all these acts, all this legislation is designed to bring in more tax money, right? That can be utilized for the service of what it is they want to do. So whenever you hear them talking about regulating, adding an act, we want to pass legislation, that legislation is never for the people. That legislation is always, right, for big business and tax, especially in this season. right? Especially now, right? It was mostly government then because the government was battling, but now the capitalists kind of won. So now it's going to be for usually the capitalists, right? So it's going to be for when I say that, I'm saying for big business, it's going to be for the government and big business, right? The politicians and big business. So now, money to stabilize market is also proposed buying troubled assets from the country's largest financial firms in the hopes of restoring confidence in the credit markets. That November, Paulson abandons the element of the plan aimed at buying these so-called toxic assets. Bank failures signal end of an era. Washington Mutual is seized by the Federal Deposit Insurance Corporation, right, the FDIC, and declares bankruptcy. The largest bank failure in U.S. history. Several days later, another major U.S. bank, Wachovia, is purchased by Wells Fargo. Meanwhile, the two largest U.S. investment banks, Goldman Sachs and Morgan Stanley, announced they will convert to bank holding companies, exposing them to additional government regulation, but giving them access to more loans from the Fed. The move marks the end of independent investment banks. So 2008 was the end of independent investment banks, symbols of Wall Street success in the second half of the 20th century, right? The Dow finishes worst week as Fed intervenes. The Dow Industrial Average suffers the worst week of losses in its history, dropping by more than 20%. During the course of the week, the Federal Reserve moves to make an additional $900 billion of short-term lending available to banks and announces plans to lend approximately $1.3 trillion to companies outside the financial sector. The central banks of the United States, the EU, Britain, China, Canada, Sweden, and Switzerland make coordinated interest rate cuts. The U.S. economy sheds 240,000 jobs in October, ushering in a period of heavy job losses that culminates in an unemployment rate of 10% a year later, right? So again, and announces plans to lend approximately 1.3 trillion to companies outside the financial sector just to keep them afloat, right? 900 billion of short-term lending available to banks, right? So we're seeing this bailout take place. Now, let's keep going. Fed announces quantitative easing. The Federal Reserve announces a plan to make large-scale asset purchases known as quantitative easing to push down long-term interest rates and jumpstart economic activity. In March 2009, the Fed announces the purchase of $750 billion in mortgage-backed securities and $300 billion in U.S. Treasuries. In November 2010, the Fed launches a second round of purchases known as QE2, and in 22 a third QE3. By the time the program is wrapped up in 2014, the Fed has expanded its balance sheet to more than $4 trillion, up from less than $1 trillion in 2008. So within 1 year, by 11/25/2008, from the beginning of 2008, it has upped, right, over 4 trillion. It went to 4 trillion, up from less than 1 trillion in 2008, at the beginning of 2008, right? Now, Bush launches auto bailouts. On the 19th, 12/19, George W. Bush administration announces plans to support two of the big three U.S. automakers, General Motors and Chrysler, with emergency financing totaling more than $17 billion. Now, they allowed which one to fall? They allowed, I think it was Ford then, right? It was one that was in the Motor City, Detroit. They allowed it to fall. And if you were in Detroit, I got to go to Detroit when this took place, right? And if you had a chance to go to Detroit, I'm telling you, it was a whole different place, right? I believe over 1 million, if not more, but at least 1 million people left Detroit at that time because there were no jobs in Detroit, because jobs were totally the auto industry, the majority of jobs, right? And so that place became like a ghost town. They are just rebuilding Detroit right now, like over the past maybe 5-10 years. They're just rebuilding Detroit, right? And so, right, the third was Ford. Right, there we go. It was Ford. So again, big three: U.S. automakers, General Motors and Chrysler. They bailed out with emergency financing total over more than 17 billion. The third, Ford, avoids a bailout. In 2009, the companies approached the government again for additional loans of more than 20 billion. By June, both have entered bankruptcy. After restructuring, the U.S. Treasury sells its remaining Chrysler stock in 2011 and its last GM stock in 2013, losing some 9 billion overall on its auto bailout programs. So that ended up failing anyway. Right? Now, Obama's early moves. Amid a wave of global spending on fiscal stimulus, newly inaugurated President Barack Obama signs a $787 billion stimulus package into law. It wins praise from some economists who laud Obama's recognition of the urgency of the moment, but others criticize the bill for raising the debt or focusing on wasteful projects. Meanwhile, Treasury Secretary Timothy Geithner unveils his financial rescue plan, which includes so-called stress testing for big banks. It also aims to use Federal Reserve lending facilities to free up credit for consumers and small businesses and create public-private partnership to take troubled assets off of businesses' balance sheets. Right? So the financial rescue plan is designed, it's the bank bailout for real. Right? Which also includes so-called stress testing for big banks, right? It also aims to use Federal Reserve lending facilities to free up credit for consumers and small businesses and create a public-private partnership to take troubled assets off of business. And when they're talking, if they're talking small business, they're talking like 50 to 100 employees, small business, not no small like little businesses, right? That's what they had to do when COVID hit. They had to help small businesses, right? And they had to help the average person. That's that's a different type of stimulus. But these were for the big banks, and these were for mid-sized business. We're calling them mid-sized. That wasn't no small businesses, unless they and they call any business under 100 employees small business. So they could fit in there, but that's just like saying white women are minorities and they could go get the monies that were set aside for African Americans. Right? That's the same. Just think of it like that, right? Yeah, if you can fall inside of the definition, but are you really that? That's the real question, right? So again, G20 summit pushes financial regulation. Leaders from the group of 20, G20, representing the world's leading economies, meet in London where they pledge to triple funding for the International Monetary Fund, for the IMF, and increase trade funding. The leaders do not make any major statement on increasing global stimulus spending, a focus of the United States ahead of the summit. Following a major push by France and Germany, the leaders do, however, announce plans to strengthen international financing. Okay. Now, 2009, U.S. banks stress tested. U.S. regulators, led by the Federal Reserve, released the results of the first banking stress test, which set out to assess the health of the country's largest financial institutions. 10 of the 19 companies tested are required to raise additional capital, a total of $75 billion across the system. The subsequent Dodd-Frank financial overhaul formalizes the stress test process, leading to yearly tests for U.S. financial institutions and a certain level of assets. Now we're at 2010. President Barack Obama signs into law a financial reform bill aimed at preventing future financial crises by giving the federal government new powers to regulate Wall Street. The bill to be implemented over several years includes the creation of a Consumer Financial Protection Bureau and a Financial Services Oversight Council to monitor market stability. The Federal Deposit Insurance Corporation gains the power to seize and dismantle troubled financial firms deemed too big to fail and proprietary trading. Right? So they're going to monitor now these banks as they did before, right? All you're seeing is re-regulation kind of here, right? That are considered too big to fail, and proprietary trading. When banks invest for their own profit is banned. The bill also limits the scope of banks' investment in hedge funds and private equity funds. All right. So you would say in 2009 is not the time to get into banking, right? So if you were looking to get in banking, what are we looking for? The next stage of deregulation, right? Which is going to be coming soon, because what's happening with these banks, it might have already came, but what is happening with these banks is, you know, or about to happen with these banks and switching over to the new monetary reality that's about to take place, right? It's going to be major. That there's going to be a deregulation. Believe me, it's going to be a strong deregulation. And I don't know what form of what form banking is going to take, but if you are looking at investing in banking, you are very close to wanting to look deep into that. If you're serious about it, if you're thinking about doing it now, you need to really look into it, and it's closer to the time. Okay. So yes, welcome Adara. Welcome to the call. Welcome to the call, or to the live. Excuse me. I'm so used to doing Zooms. Right. I do so many Zooms. All right. So on 9/17, protesters began occupying Zuccotti Park near Wall Street in Lower Manhattan, where they remain until authorities expel them in 11th month, objecting to growing wealth inequality and what they see as corruption and favoritism during the corporate bailouts. They inspire similar actions around the world. A year before, the so-called Tea Party movement had gained traction among the Republicans with similar complaints against the TARP program, bank bailouts, and what they considered wasteful spending through Obama's stimulus package, which you're going to see this all throughout the history. It wasn't Obama's stimulus package. That which has been is now, and there's no new thing under the sun. They've been doing this since banks have been in business, right? So if you followed us through part 1, part 2, and now part 3 of this historical treatise, I'm letting you know there's been ebbs and flows going back and forth, and you're seeing this over and over and over again. Authorized by Dodd-Frank legislation, regulators finalized the so-called Volcker Rule, originally proposed by former Fed Chairman Paul Volcker. The heart of the rule is to reduce systemic risk in the U.S. financial system by prohibiting commercial banks from proprietary trading or using their customers' deposit funds to make risky bets in the market, which they were doing all the time, right? Risky, but they still invest. They're still making a profit, but they're not allowed to do risky bets according to this. This is the Volcker Rule. Now, the rule draws criticism from the banking industry, which argues it's too complicated and costly to comply with. 2014, TARP ends. The Treasury sells its remaining shares in Ally Financial, formerly the financing arm of General Motors, offloading the last major investment from the Troubled Asset Relief Program. The Obama administration announces that program resulted in $15 billion profit, with the government recouping $441 billion on the $426 billion dispersed. Critics maintain that the bailouts created a lasting moral hazard for banks and contributed to the polarization of American politics, right? Of American politics. That means that created a further dispersal of polarity between the Republicans and the Democrats, basically, right? That's what that's saying there. Now, on my birthday, June 8th, 2017, Dodd-Frank repeal passes the House. Republicans in the U.S. House of Representatives passed the Final Choice Act, which would largely dismantle the Dodd-Frank reforms. Provisions include exempting many banks from stress tests, repealing the Volcker Rule, stripping the Consumer Financial Protection Bureau, and much of its power. So now what happened? Deregulation. That was it. That was deregulation, right? Easing other regulations on financial institutions. However, the bill in this form fails to advance to the Senate. Right? That would have been deregulation. Now, President Donald J. Trump appoints Mick Mulvaney, the head of Office of Management and Budget, as acting director of Consumer Financial Protection Bureau, CFPB, the financial watchdog agency created by Dodd-Frank. Critics accuse Mulvaney, who previously called the CFPB a sick, sad joke, of undermining the agency's mandate by rolling back regulations, slowing enforcement measures, and favoring private lenders. In August 2018, the agency's top student loan official resigns in protest. Okay. Now, Boom. May 24th, 2018. Trump signs Dodd-Frank reform bill. Here we go. This is right regulation. Deregulation. So Trump signs the Economic Growth Regulatory Relief, which would be deregulation, right? And Consumer Protection Act, the first major financial legislation since Dodd-Frank. The bill passed with bipartisan support in Congress, keeps the Dodd-Frank framework, but exempts many smaller banks from the regulatory scrutiny imposed after the crisis. Now only financial institutions with more than 250 billion in assets rather than 50 billion will be subject to increased federal oversight, though the bill gives the Fed discretion to include smaller banks if it deems necessary, right? So this ends at 2018, and we're going to end with the historical treatise here. And where we are today, right, is a total different place. The banks have restructured. I might go into that in a different session, but we're going to end our historical treatise here. Now, what I do want to do is I'm going to pull up, give me 1 second. Okay, let me do this for you all. I'm going to pull up another form, and that is our cash flow worksheet, right? And hopefully I believe that you all will be able to see this. Yes. So this is our cash flow worksheet, okay? And we've been working on it. I'm going to clear the numbers probably the next time we get into this. But what I want to do is I want to make sure that we understand what we just looked at, okay? So I'm going to do a brief recap, all right? And then we'll move into that, okay? So I'm going to do a brief recap. All right. So, in the brief recap, what I want us to understand is America started off with no banking system, right? So, there was no banking system to an unregulated banking system to a big boon in banking, right? Where the actual bank, remember, and banking was private. So, and it really is private, not was, it is private. But remember, they made the FDIC, which is the Federal Reserve, which is a private banking institution. They made the FDIC a government agency later down the line. So I want you to be careful. But banking was a private industry. Banking as a private industry, they saw an unregulated market. The market was not saturated. Everybody jumped in, and millionaires and billionaires were made, right? So who became a billionaire at that time? We know that JP Morgan became a billionaire at that time. We know that Carnegie became a billionaire at that time. We know that we know that Rockefellers became billionaires at that time, right? And then they created what? Bank. They had Standard Oil. They turned that into Standard Oil Trust, which was a bank, right? And so all of that was going very well, right? So now, then what took place was after we saw that take place, then came there was a bank failure, right? They brought regulations in. No, there was a panic induced bank failure came about. They promoted the panic, and the large banks like the Carnegies and Rockefellers and the JP Morgans and Rockefellers bailed the banks out. We saw that, correct? So when we saw that take place, then what happened? Then came regulation. Then they brought in regulation as well as taxes. And then we saw them go after who? The big banks that were able to bail them out because they didn't have to depend on the government. So now we see the government going after the big banks, and they use JP Morgan to be able to save the country, right? But then they came after him. So I want you to understand there was a war going on between the private banking, which was a capitalist, and the government itself, because the government wanted to rule. They wanted to be the big boy. They wanted to be the ones on top. So then we see more back and forth, but we get to a stage where the federal government actually ends up taking over banking through legislative acts over time. In other words, by increasing regulation. By increasing regulation, they were able to increase in tax to the point where the feds were able to come in and take it over, right? which again is a private banking institution, though. Right? So it went from national banks to state banks to federal bank, national bank, state bank, right? Now everything is regulated by that. So when we get to this last stock break or this last banking breakdown, right, where we saw in 2008, the government, the FDIC, bailed out many of the insurance companies, which are part of banking, the banking companies, right? The mortgage, savings and loans, all of those companies were bailed out by FDIC minus Lehman Brothers. So the government came to the rescue this time, meaning they have the complete power. I want you to be clear in the eyes of the people. But capitalists are really capitalists, right? Because we saw what? What did we see here? We saw something very important in this last conversation. Hold 1 second. I want to go back to this because this was an important point. Not TARP. No, this was 2008, right? Was bank stress tested. We did that. Hold on 1 second. I want to make sure. General Motors, we watched that crash. I want to get this to you because I want to make sure I want to get this across. When we see the end of independent investment banks, that's important, right? That's a big change. All right, let's go through. That's 2007. I don't want to go back that far, I don't believe. Industrial average, sorry about that. 2008. And I know you guys can't see this with me. Hold 1 second. Now you can. All right, you should be able to anyway. Let me make sure on that. Yeah, you can see it now. Okay, so let me see. That plummets. JP Morgan, here it is. Bear Stearns announces major liquidity problems and is granted a 28-day success loan. Now I want to go with JP Morgan Chase buys banks Bear Stearns for $2 per share in a rescue deal. So JP Morgan again is in this rescue deal. So that means that the capitalists again are super strong. So remember, they had lost power, but now they're coming back at this time and regaining power. Hence, possibly a reason for the crash. Don't ever put anything past the government when it comes to power. Period. Or the capitalists. Either side, right? Don't put nothing past either side. Right? Because they will do whatever it takes to win. So I want you to understand that, okay? That's very important there. Now, so with that, we see all the way up until now, this whole process is called the actual financial crisis. So we've been living in a financial crisis since 1992 in reality, right? And so now in 2023, you're seeing some big things take place. What? No bank. This is what I want you to understand, Clara. This is an excellent question that you asked. This is an excellent question. Her question is, so which bank is better to invest in, and what to which stock or stock to invest in, to invest in? That is an excellent question. And that is the whole reason that we're having this conversation, because this conversation is become your own bank. And this is what I wanted you to see. See, this is what's so powerful about this conversation is that you're asking the right question. I want you to notice some things that you said that are right in this question. First, so which bank is better to, you didn't say put my money in. You said to invest in. You used the right word, invest. We're changing our language. That takes financial literacy to even have that statement come out of your mouth, right? And to which stock or stock investment to invest in. Those are excellent questions. Phrased pretty much correct. I like the way you even phrased the question. And this is what we're talking about, because when you start unlocking those type of conversations, this is when you're going to get to the truth. This is when we're going to get to true financial literacy. And the answer, we all are learning. We all are learning because, again, finances are taught in the house. I mean, at home, right? Finances are taught in the home, not in the educational centers. And if you've been watching the Rich Dad Poor Dad, I just did Rich Dad Poor Dad Part 7 today. With the Rich Dad Poor Dad Part 7, he speaks specifically in that book on what you just said, right? But you have to humble yourself and become like a child to learn it. You have to admit, I don't know anything about. My parents didn't teach me this. Is what you got to learn. That I was blessed. My father actually did teach me some of these things. I was blessed with that. My father owned a business. He taught me some of these things, but not to this level. But he did teach me, like he made us read The Richest Man in Babylon. That's an excellent book to understand getting out of the debt cycle. But I didn't understand compound, even though it's in that book, I didn't understand compound interest to that level, the eighth wonder of the world. So what I want you to get is most people, and I'm going to go back to this form here. That was an excellent question. Most people understand income. They're trying to get income to come in, right? The above average are trying to get assets and investments, right? Assets here and investments here, right? That's what most people are trying to get: income, assets, and investments. But what they're not understanding is interest. This is what the wealthy 1% live off of. They live off of interest. So that's what we want to do. So how do you get interest? You must have high yield, no risk accounts. And the only way you're going to get the high yield, no risk account, which is what we should be doing, is through private banking, which is going to be becoming your own bank. Right. And so what I'm going to do, because there are some slides and things that I want to get into so that we can talk about average rate of return versus true rate of return, uninterrupted compound growth. We want to talk about those things, but there's some slides that I need to put together to be able to get that information to you. So this ends, part 3 ends our treatise on this. I'm either going to do it late night tonight or tomorrow morning, depending on how I feel. I feel pretty good. So it'll probably be late night tonight. If not tomorrow morning, it'll be part 4. It will be the final portion of this series for sure. Okay. And so we will go into truly how to become your own bank, what it means to become your own bank, and how that will work. Okay. So I appreciate everybody's time. If you missed, I'm going to go over some things again for you. If you missed workshop 1, understanding money, you need to go see it. Go find it, get it. You need to watch it thoroughly, right? That was very important. Workshop 2, legally avoid taxes. We did a historical treatise and then went into legally avoiding taxes in one part. And that this will be the longest series, I believe. I believe this will be the longest series because banking is such an important history and understanding it. And now that you've heard it, you see we're getting the right questions asked. What should I invest in? What should I be doing? That's what you should be asking at all times. You should be constantly looking for, what should I be investing? What should I be doing? Right? That's inside of this as well. Becoming your own bank, right? As well. And so get with us tonight at 7:30. We're going to be live on Zoom. I need you to contact me for the link, right? I'm going to drop the link in here for you guys. copy and paste it, or contact me to get it. You will be able to join at 7:30 Central Standard Time, 8:30 Eastern Standard Time for a live walkthrough that's going to help you to be able to see what it is we do. If you want to work with our experts, what is required to do that. We're going to also have a 30-minute mindset training as well, so that you can get information and get your mindset in the proper place for making money. Okay, so this is going to be extremely important. All right, extremely important that we win. Okay, I will inbox you, Clara. No problem. No problem. All right. As a matter of fact, I'll inbox you when we go live. How about that? Like I did this time. That'll be perfect. Okay. As well, everyone, welcome to the call. I'm so glad you guys are here. Adara, I'm so glad you're here as well. Celia, glad you're here. And everyone else that has shown up and been a part of this as well. And then tonight at 9:30 Central Standard Time, 10:30 p.m. Eastern Standard Time, we are going to move. I've been invited to the Lions Den. I'm going to be on a live with them that evening, and for an interview. It should be very good. I'm looking forward to it. I like the name Lions Den, of course. And I'm going to go in there and we're going to share and have a good time and enjoy. Okay. So with that, I'm looking forward to those of you that can attend everything to be there with us. Those of you can attend some, looking forward to you being there with us. And I'm looking forward to the replay, you all being a part of the replays, where those will be provided on what I do. So we will have a replay of today. Again, if you have not been watching the Rich Dad Poor Dads, I advise you to watch those. The reason I'm doing the Rich Dad Poor Dads is because step by step by step, we are walking through the process. All right. So this workshop ended up being a little bit longer, but we will definitely have, I will definitely have this workshop one more day, and there will be no history lesson inside of it. This will be straight practical application. Okay. So with that, I appreciate everybody's time. And again, see you all at the top. And I love you all with a perfect love. And there's nothing you can do about it. Peace.